If you've ever wanted to buy a stock only to watch it soar without you on board, you need to watch this video. I'm Seth Freudberg, and we're one of the top proprietary trading firms in the world with numerous 7- and even 8-figure per year traders. You found the right place to learn. If you're like just about any trader or investor, I'll bet you can recall many times that you've watched as a stock you love skyrockets in price before you got a chance to buy it, and before you know it, it's priced too high to safely enter. In fact, you might be convinced that the more likely scenario at this point is a pullback from its current price, and so you're stuck. You want to own the stock, but it's just too pricey to take the chance. Is this familiar? Well, what if there was a way to actually profit from the inevitable pullbacks of a stock that is overbought and be able to acquire the shares at a much cheaper price? Well, there actually is a way to do just that with a very simple option strategy known as the put ratio spread that we're going to be teaching you in this video. Now, before we get into the option strategy that we'll be teaching you in today's video, if you're absolutely brand new to options trading and you don't know much about how options work, we've put together a video for you to understand options basics. And if you click the video appearing on your screen right now, it will lay the groundwork for you to understand the option strategy that we're going to be sharing with you in this video. Then when you're finished, you can come back and watch the rest of this video. Okay, so as many of you may know, Tesla had a really lousy 2022, dropping from over 400 at the beginning of the year and hitting nearly 100 by the end of the year, closing the year 123.18. But then in 2023, the stock started to bounce, and by August had more than doubled from its year-end 2022 price, closing on the 1st of August at 261.07. So suppose that we were a Tesla bull and we wanted to buy, say, 300 shares of Tesla. Well, we could have just outright bought 300 shares that day for $78,361, as you can see from your calculation. And that, of course, is one choice. But if we were of a mind that stocks that double often have a pullback before they resume their upward climb, then there is another approach that you can take. And that's what we're going to be teaching you today. And so let's say that on the first day of August, we pull up an option chain expiring 45 days later on September 15th, and we went ahead and bought the Tesla 250 put, about 5% below where the stock is trading. And then we very intentionally find another put below that. In fact, we go down as far as we can to find a put that's just a little bit more than half the price of that first option that we bought. And in this case, that's the 235 put, which is trading for 565, while the put we bought is trading for 1020. And we go ahead and sell two of those 235 puts. Well, when we do that, we are entering into what options traders refer to as a put ratio spread. And you'll see very shortly exactly why we did this. And so the first thing that we need to understand is the cash flow of this trade so that you'll understand how it works. And so starting with the two puts you sold at the 235 strike price, you sold two of those. And so with the price of 565, you multiply that by 100 because each put option contract represents 100 shares of Tesla, and you sold two of them. So you multiply that total by 2 for a final cash inflow from those two puts of $1,130. And then you subtract out the cost of the put you bought, which was $1,023, resulting in net cash flow of $107 when you start the trade. And that cash goes right into your account, and it's yours regardless of how the trade comes out. And so now you can see why we look for puts to sell, which had a value of a little more than half the value of the put we bought, that 250 put, because we wanted to have positive cash flow. And soon you're going to understand exactly why. And also please note that had you made this trade, you would have needed to have $23,500 in cash in your account to make sure that you had enough cash on hand should you be assigned 100 shares of Tesla, and you'll soon understand why I say that. Okay, so let's now move to the day that this options chain expired, which was September 15th, 2023. And as you can see, Tesla closed at 274.39 that day, and so as you probably realize, a put option doesn't have any value if the stock is trading above the strike price of the put option because there's no value to the right to sell your shares at a price lower than a stock is trading in the open market. So as you can see, we can calculate the trade profit by starting with the initial cash flow of $107 we got, and honestly, that's about it because both puts expire well below Tesla's closing price and therefore expired worthless. So we just pocket the $107 of cash flow. And let's think about this for a minute because remember, we would actually like to buy 300 Tesla shares, but only after a pullback. Well, the pullback never materialized, so while we didn't acquire the shares, we did make a little bit of money, and that can happen for many months as you wait for the pullback. But if you think about it, you're getting paid to wait. Okay, so we're going to continue to run this program until we accumulate 300 shares that we want to acquire, as we said in the beginning. So let's keep a scorecard of the outcome of the trades. And so now we've logged the September trade, and we're going to immediately open up the next trade, again, about 45 days later on the October 27th options chain, which is actually 42 days out, but it's the closest chain to 45 days out. And as you can see, in this case, we bought the 260 put, which again is 5% below the stock's closing price, and we sold 2 of the 245s, which was as low as we could go on the options chain to find a put option priced at a little bit more than half the price of the option we bought. And so, of course, that's going to result in positive cash flow again, as you can see. And this time we receive $234, and we'll need to set aside $24,500 in cash should we get assigned the shares of Tesla at expiration, as you can see. Okay, then moving to the expiration of the October trade, you can see that Tesla had in fact sold off quite a bit during the period of this trade, closing at 207.33. And so this is where things get really interesting because remember, we bought one 260 put, but we also sold 2 245 puts for the October trade. And so when we look at the value of those options that day, you can see that the 260 put is worth 53.22, which makes sense, right? Because the stock's trading about 53 points lower at 207.33. So anyone who owns that stock gets to sell their shares of Tesla for about 53 points higher than they could actually get in the open market. And so that option is priced at 53.22. But the 245 puts are also priced very high because those are located about 38 points above where the market's trading. So the right to sell your Tesla shares so much higher than they're trading in the open market is also very valuable, trading about 38, which makes sense. And so what we're going to do at this point is to sell our long put at 260 and buy back one of the 2 short puts at 245. Now, if you're wondering what we're going to be doing with that other short put, well, the answer is nothing. We are going to simply allow ourselves to be assigned 100 shares of Tesla at that strike price of 245 because we were the ones that sold that put. So we're the ones who have the obligation to buy those 100 shares at the strike price. And that's exactly what we'll do, which is how we're going to acquire the first 100 of the 300 shares we're accumulating. And you'll note that we ended up buying those shares far below where they were trading the day that we started the campaign, if you'll recall. And so getting back to the options portion of this transaction, you can see that we start with the 234 that we received when we originated the trade. We then cash in the 260 put for $5,322, as you can see from the calculation, and we pay $38.18 to buy back that one 245 put, resulting in an overall options profit of $1,738 on the options part of this trade. And don't forget that we're acquiring those 100 shares at $245 per share. And so updating our scorecard, we show that we actually made a lot of money on the options in the downturn of Tesla, but we also own 100 shares of Tesla. Now let's move on to our next trade, which is the December trade, which expires 49 days out. And as you can see, we bought the 195 put, again, 5% below Tesla's closing price, and we sold the 180s, which are trading a little bit more than half the price of the 195 that we bought, just like we did before, resulting in a positive cash flow of $131. And this time, you'll note that we only need to set aside $18,000 for the possibility of getting assigned, because even if we're going to get assigned another 100 shares at the 180 strike, in a similar way to how we were assigned the first 100 shares, we're going to be needing that cash in the account, and that's why we need $18,000 set aside for that possibility. Okay, so now let's move forward to December 15th. And you'll see that Tesla bounced and was actually trading at $253.50 at the close. And so we just pocket the $131 we initially received because both put options expired worthless, so far below the closing price of Tesla that day. And so we'll update our scorecard accordingly. And of course, we immediately turn around and enter the January 26th trade, expiring 42 days later. And as you can see, we bought the 240, again, 5% below Tesla's trading price, and sold two of the 225s, resulting in positive cash flow this time of $99. And because we're short the 225s, we'll need $22.5 in cash set aside. And as you can see, we're going to need it because right after we put our trade on, Tesla sold off all the way down to 183.25 on the day that the January trade expired, resulting in our, again, because these options all have value at expiration, we're going to realize that gain in our options position by selling off the long 240 option and buying back one of the two short 225 options and allowing the other 225 put option to be assigned at a price of $225 per share, just like we did before. And so as you can see from the calculation, that again results in an options profit, in this case, a nice profit of $16.06. And we are also noting that we now have another 100 shares of Tesla. This time we paid $225. Okay, so now we're going to move to the March trade, which in this case, with the long put always 5% below Tesla's trading price, we placed that long put at 175 and the short two puts at 165, resulting in net positive cash flow of $85 and a cash requirement of $16,500, because now our shorts are all the way down at 165, and interestingly, Tesla closes just 34 cents above the 165 long put the day the options expire. So both put options expire worthless, meaning on the March trade, we get that $85 win and we move on to the next trade. And so the April trade, where we're long the 165 put and short the two 155 puts, resulted in $120 of positive cash flow. And as you can see, Tesla's sell-off continued, closing at 147.05 on expiration day. And so we again have the opportunity to cash in some more options profits, doing just what we did before, selling off the long put and buying back one of the two short puts, which results, as you can see from the calculation, as another options profit of $1,095 and the acquisition of another 100 shares of Tesla, this time at a price of $155 per share, way below the price of the stock at the beginning of this campaign, you'll remember. And so we'll update our scorecard now for the April trade. And so as not to be too tedious for you, we'll just share with you that Tesla began to bounce. The next trade, which was a late May trade, as you can see, both options expired worthless because Tesla had bounced. And so we just pocketed the initial 151 of initial cash flow yielded at the initiation of that trade. And the final trade to bring the campaign around to a full year ended in July of 2024. And the stock again closed well above both the long and short put options, resulting in an options profit of $114 for that final month. And so the year-long campaign resulted in total options profits of $5,027. And of course, those 300 shares that we were looking to acquire, which we did at various prices as Tesla sold off, we got those shares. And so to summarize the entire campaign, the value of the 300 shares that we now own is $74,469. And when you subtract out the cost of those shares, which we paid 3 separate times that we were assigned, we got 100 back in October for $240 a share. We got 100 in January for $225 a share. We got another 100 in April for $155 a share. And then finally adding back in the options profit, the total campaign had a profit of $17,496. And so I want you to think about it. Had you just bought the shares back in August of 2023, you actually would have suffered a loss of $3,850, as you can see from the calculation, because the stock actually went down. But instead, even though the stock had lost value between August 1st in 2023 and July 12th, 2024, your put ratio spread campaign would have made $17,496. And so what I'd like you to take away from today's video is that if you ever find yourself in a situation where you want to get long a stock, but you just hate the current trading price, the put ratio spread technique is fantastic for both profiting from the pullback that inevitably strikes overbought stocks, and at the same time allows you to enter the stock at much more reasonable prices if the pullback that you had expected actually transpires. And every month the stock doesn't pull back, you get paid anyway because you collect a credit every time you enter a put ratio spread trade. But the real money on the options trade is made in the pullback. And more importantly, you keep adding to your stock position at a better and better cost basis as the stock drops, setting you up for a terrific profit if the bounce comes, which of course is the reason you wanted to get into the long shares in the first place, because you believed a bounce was going to come. Professional options traders are aware of all of these option strategies, and they're available at any time once you spot the opportunity.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.